Okay, I think now we can kick off. So basically this is you study 11, unit 11 question on property plant equipment. So we're gonna now run through the question. So it says, okay. So it says the following information was extracted from the accounting records of SS Supermarket, right? So now that SS Supermarket is, I'll highlight that because SS Supermarket is who the entity that we're dealing with here. And then it mentions on your first point that your balance is at the 1st of March 20.1. So here, this date, if I was you, I would also highlight it because the date usually kind of gives you where you are in the year. So it's saying the 1st of March 20.1. So you note that it's the 1st of March 20.1. Okay. Then they've provided you information saying vehicles at cost is 28,000. And then equipment at cost is 2,800. Accumulated depreciation for your vehicles is 14,268. And then for your equipment is 543. So these are balances that have been provided to you at the 1st of March 20.1. So these are balances that you should ideally note. We're going to read through this whole question and then we'll come back to these balances again. The second point then mentions the following transactions in respect of non-current assets took place during the year. So they're mentioning that these transactions took place during the year. So now you've got this date of the 1st of March 20.1, and you've got these balances. They're telling you these transactions took place during the year. So if I was you guys, I'm already starting to think that, okay, these are most likely going to be my opening balances because these transactions took place at the beginning of the year. But anyway, let's read further and continue with that. So on the 31st of August 20.1, I would also highlight that for myself. SS Supermarket sold their delivery vehicle to Ms. Peterson for 7,200 cash. So they've sold one of the delivery vehicles. We've got that now for 7,200. And it was sold on the 31st of August 20.1. Okay, perfect. Then you go, the proceeds from the sale from this sale transaction was used to help finance the purchase of another vehicle on the same date from Cape Motor Limited for 22,000 in cash. So they've sold the one vehicle on the same date, and then they used the proceeds to then buy another vehicle for 22,000. So in the statement, there's two transactions that have taken place. So I would mark that. So you have two transactions, right? The first one being a disposal, and the second one being an addition. Okay. And then it further elaborates here. The cost price of the vehicle sold was 12,000. So they are telling you the cost price was 12,000 and its accumulated depreciation amounted to 6,455 on the 1st of March. So highlight that 6,000 on the 1st of March. That's why I said the date is important there. We're looking at the 1st of March, that's 6,455 on the 1st of March 20.1. That's what happened. Then on the 28th of February 20.2. Now 28th of February 20.2, you're looking at that date and we're looking at the 1st of March. What I then can already start to deduce and start to have an insight to say this is most likely going to be the end of the year and the 1st of March is the beginning of the year. But we're just reading through this with a clean lens. So let's continue. SS Supermarket sold a used printer to Mr. Moon for 720 in cash. So they sold this for 720. So we already know there's a disposal of equipment on this date. They are further providing us that the cost price of the printer is 900. The accumulated depreciation on the printer is 164 at the 1st of March 20.1. So they're also providing you that information of what your cost price is, as well as your accumulated depreciation on the 1st of March 20.1. Okay, now we read further. It says depreciation must still be provided for as follows. Now, every time when they say depreciation must be provided as follows, you should always be thinking to yourself, which depreciation method are they using? You know that there's cost, a straight line method, there's diminishing balance method, and there's production unit method. So every time you see depreciation that they're really referring to depreciation, in your mind, you should already be thinking, is it straight line? Is it diminishing balance? Is it production unit method? It mentions here, vehicles are at 20% per annum. So they're saying that we're going to depreciate our vehicles at 20% per annum on the diminishing balance method. So they've let you know that we are going to depreciate these on the diminishing balance method. And in the diminishing balance method, we are depreciating our assets based on their net carrying value. So it's your cost less your accumulated depreciation, which gives you your carrying value, and then you'll apply your percentages into that. Now, in equipment, they're saying that equipment is at 10% per annum on the diminishing balance method. So you've got, again, depreciation at 10% a year, and it's on the diminishing balance method. Happy days. Then the financial year commences on the 1st of March. Okay, so they're telling us the financial year commences on the 1st of March. Usually what I used to like doing was, do that. I'll do timelines. So here, okay. So here, I would say beginning of the year. We are told is the 1st of March 20.1. Okay. And then when we have a look here, that means that if our beginning of the year is the 1st of March 20.1, if you even calculated the end of the year should then be will then be the 28th of March, 28th of February, apologies, 28th of February 20.2. So now you know your beginning of the year and the end of the year. The reason why this is important in a PPE question is because you find in these transactions, we have depreciation that we are selling an asset in the middle of the year, and we're also buying one during the middle of the year. So you kind of need to know where you are within the year to be able to properly calculate your depreciation throughout the year. And then here it further confirms at the bottom here. Okay. Prepare the following journal ledger accounts of SA Supermarket, properly balanced, closed for the year ended 28th February 20.2. So this is now confirming that our end of the year is that 28th February 20.2, beginning of the year is the 1st of March 20.1. Happy days. Now, in this, when you even look at it, the question that I was asking that when we highlight the 31st of August 20.1, that means that we disposed your vehicle on this date, and we bought another vehicle on this date. So if you put it in your timeline here, just have that. You've got 31st of August. Okay. Now, why this is important to note this date, because if you look here, from the beginning of the year till the point where we sold and bought another vehicle, there's 6 months. So, and from the point where we bought an additional vehicle till the end of the year, there's also 6 months. So these are key points to note. Okay, now we move to the required. It says prepare the following general ledger accounts of SS Supermarket, properly balanced, closed for the year ended 28 February 20.2. Okay. Now, the accounts they're looking for is your vehicles at cost, equipment at cost, accumulated depreciation on equipment realization, and your depreciation accounts. After having a look at the required, this is ideally what you'd want to see. So before you even go anywhere, inputting anything, you should have your T, you should start drafting your T accounts, because this is what's required of you. Your general ledgers, I used to call them T accounts, your T accounts. That is what is required of you for each of the following accounts, these accounts: your vehicle cost, equipment and cost, accumulated depreciation, realization, and your depreciation. So these are the ones that we are ideally looking for. If you haven't drafted them, I think, not too sure if you're able to see it. I can give you guys time to quickly draft these empty ones. Apologies. So for each of these accounts, we want to see one for vehicle, T account for equipment, a T account for accumulated depreciation on the vehicles, accumulated depreciation on your equipment, realization of your vehicles and equipment, and depreciation. So I'll just leave it like that. You guys can quickly write it. I'll give you some time to draft that. Okay, I think now we should be fine. I'm handing over to my colleague Tulani to help you with the calculations, and then I'll come back to wrap up the T accounts. Tulani?
Hi, Vuyo. Before I take over, Vione, I want to propose if we can give it to for questions, because I'm noting some questions on the chat. So
Okay.
if we can just before we then continue, so that we can take questions relating to the scenario.
Yeah. Are there any questions which we missed, guys? Sorry, I couldn't see the meeting chat, so let me have a look.
On the chat, there is a question relating to, I think this one is just a clarity with regards to the number of months. So it seems like there is a confusion. Yeah, whether it should be 5 months or it should be 6 months, if you can just maybe clear that.
Okay, so on that, it's 6 months from the 1st of March to the 31st of August. So when you do it, I usually calculate it with my fingers. It's the 1st of March, it's April, it's May, it's June, it's July, and it's August. Because it's the end of August, the 31st of August. So that equates to 6 months. And then on the other half, we then start from September. So we go September, which is 1, October, which is 2, November, which is 3, December, which is 4, January, which is 5, and then February, which is 6. So you have 6 on the 6 months from the 31st of March to the 31st of August, and then also from September until the end of February, which is being the 28th of February 20.2. I hope that clarifies that. Please let me know if you're still uncertain on that. I can see a hand. Ramutibe. Okay, let me just check here.
Good evening.
How are you?
Good. Can you just please go back to the questions? Just want to ask a question with regards to the accumulation.
Okay, I'm back here.
With regards to the accumulated depreciation, since this one now, the opening balances or the balances as of 1 March are given on this statement.
Yeah.
So when we are calculating the depreciations on number 3, is that going to be inclusive of the ones that are already given here? And also on 2.1, when we are taking note of selling the vehicle to buy the new one, are we going to account for these that are already given here on the
vehicle? Yeah, so with the cumulated depreciation, this one is your cumulated depreciation here of that 14 and the 543 is at the beginning of the year. So what we are now going to do in the transactions 2.1 and 2.2, we're going to now depreciate the asset, the first asset which is disposed of for the first 6 months. And then after that, because we have then dispose of it, we'll then realize a profit or loss and calculate that in the realization account, which I will run through just after the calculations have been, my colleague Tulani has run through the calculations. And then on the addition, we're going to then calculate the addition of the vehicle for the 6 months because we bought it on the 31st of August. So we are now going to take into account the depreciation for the 31st of August until the 28th of February 20.2. So there'll be 6 months where we're depreciating the assets that's new and 6 months where we're depreciating the asset just before up until we sell the asset. So that will be taken into account there. And then on the, does that make sense?
Yes, yes, absolutely.
Okay. And then on the printer, because we sold this printer at the end of the year, we are going to depreciate it for the full year. And then because
12 months.
for the full 12 months and realize a profit or sale, profit or loss at the end of its 12 months. And then we will there's then existing, because then these are just relating to disposals and additions, and this is now disposal. We will then also depreciate the existing, which we would classify as these balances where we take your cost less your accumulated depreciation and get a carrying value, and then apply the depreciation percentages to find out what the depreciation is for the year. As was similar with the equipment, we will do the same thing where we will take your cost, deduct your accumulated depreciation, and then apply our depreciation percentages to then get the depreciation for the year. Reason why we're doing that is because depreciation is based on the diminishing balance method, right? So that's why hence we are doing cost less accumulated depreciation to get your carrying value, and then that's what we are then depreciating. Had it been another method, but let's leave that for that now. I'll raise it later, not to confuse others as well.
No, thanks for that.
And then, yeah, my colleague will then run through, he's going to run through these calculations in detail. I was just giving high level here, just things that we should have a look for, pay attention to, especially when you read the question. Hence, I asked you to read the question first, and then I will go through the question, and then we're going to run through the calcs now. Lerato, I see your hands up. Let me unmute.
Yes, good evening. Yeah, I just want to ask, because you mentioned that on 2.1 we're starting to calculate it. It's saying on the 31st of August 2021 or 2001. In this case, I get confused on the months. So you're saying the 6 months is from 0 March to August, or because we're raising these questions, given that financial year, we're going to calculate it from September, October, November, December until the 28th of February, that closing year.
Yes. So what we're doing is that we're saying that because we had this delivery vehicle here that's worth this delivery vehicle here, they've given us here the cost of it of 12,000 and the accumulated depreciation here at the beginning of the year. So we owned it for this first 6 months. So we owned it up until the 31st of August, which when you look at it, it also used to confuse me a bit, even back in the days when I was a student, to say. That's why I always use I still till this day use my thumbs. In the middle of exams, people think yeah, but so when you look at it, it's the 1st of March. So you look, that date is the 1st of March. So we're counting. So it's going to start from March, 1st of March. So we're taking March, then we're going to do April, then we're doing May, and then we're doing June, then we're doing July, then we're doing August. August up until the 31st, which means it's the end. So if you calculate that, those months, you're looking at the 1st until the end of the 31st of. If they had said the 31st of March 20.1, it would be 5 months, right? Because you'd then be starting from April, right?
Yeah, I get you now.
Yeah, that's how we see it. And then the second part of it is because and that's why hence I just wanted to run and make you guys aware that there's actually 2 transactions in this one. They are telling you here we are selling one, but at the same time we're buying another one for 22,000. So hence it's a disposal of one and an addition of another one. So they're using that money from the sum of the money to then acquire another one. And that's where we then start depreciating this one that has been acquired in the second half of the year because we bought it on the 31st of August 20.1. So moving forward, it's ours, we own it. So we depreciate it for the next 6 months up until the 28th of February 20.2.
Okay. While my hand is still up, it's not relevant to this exercise though. I'll just like at the end of the session just to explain the volume method. I just want to check if they were to say the units per a year is 2,000 units. Oh, sorry, like 1 year is 500. Then they give you a diminishing period of 5 years. Do they give us the units per year, or we have to determine, is it always total? There's one exercise that I did from the book. Is it always total to 2,000 units in a certain period? If such question was to rise, I'm not saying we should do it now. If you can just answer me this at the end of this session regarding the volume method.
Yeah, happy to answer you. I know you're referring to the one on page 13 in your study guide,
Yeah.
the production unit method. And
Yeah.
okay, let's hang 10 on that. Hang 10. What I'll do at the end of the lecture, I will stay behind and I'll explain it to you. I'll even share my screen and we can do, yeah.
Okay, thank you. Thank you so much.
Tulani, I think you can take over now. Let me stop sharing my screen. Do you want to share your screen, Tulani?
Thank you, Vio. Yes, I will share my screen as I proceed. Yeah, so you can stop, it's fine. Good evening, everyone. My name is Tulanis Khonwane. I'm one of the tutors, and then we are co-presenting this session today with Vuyo. I will be taking you through the calculations for the purpose of this scenario. Vuyo has already done most of the work. I can say crucial part of the exercise, which is going through the scenario to digest some of most of this information, and then also taking you guys through the skeleton of what you have to put down when you attempt to answer this exercise. So from my side now, I'm just going to fill in the missing puzzle of this part with which is the calculations. Vuyo, can you share that document in the meantime? I just want to start there, and then I will share mine.
Which document do you?
Because I'm requesting that already highlighted most of the things that we then need to start there and then continue.
Oh, okay. Yeah, sure. Let me do that.
Okay. So, guys, when Vuyo was taking you through this, he have highlighted the most important part, which is the timelines. You have touched on the timelines, and then you have also taken you further in terms of moving from where our financial year starting, the expected movement for the year throughout the end of the financial year, because that is important. And then he has also taken you through how you should approach your questions in terms of the structure. I'm saying this because if you look at the question that they are putting there, the question it says number 1, prepare the ledger accounts for your vehicles at cost, equipment at cost, accumulated depreciation for vehicle, accumulated depreciation, equipment, realization account, and depreciation. When you do that, when you approach this kind of question, the first thing that you need to look at, and this is another way of scoring those free marks, is to check in terms of what are the numbers on the information that you don't need to recalculate. It's just a matter of you identifying those amounts and then transferring them to your answer. And then from there, because obviously when you already have the structure that you already prepared, like Voyo indicated there, you already know what you have in front of you on the information and what is missing that you then need to perform calculations for. It's not a matter of just jumping to calculation and start calculating, because sometimes you might find that whatever that you are calculating is not even required for the purpose of the required that you are attempting. So now let's go on our scenario. I'm not sure where, because I can't see from my side. Are you sharing?
Yeah, I'm sharing. Guys, can you see it?
For some reason, I can't see from my side.
Let me try reshare it.
Okay. All right. Okay, so it seems like everyone can see.
I think they
Okay.
can see. Let me try.
Right. No, but it's fine. If they can see, it's fine. Because I have it with me here. So yeah, okay, no, it's fine. Let's continue now. So the point I'm trying to emphasize, guys, is the point of scoring free marks. So now, in our case here, for this ledger account that they are asking us to prepare, already from the information that Voyo took us through, we can already see that there are some of the amounts there that we can already just transfer them from the information to our solution, because they are given. Let's start with the opening balance. You will have realized when you were preparing these structures that that each of these T accounts is starting with the opening balance. So now, if you're starting with the opening balance, it means then from there, from the information, these opening balances are already given. Like I indicated, that it's important to highlight where your financial year is starting. You will see on the table there that we have all the opening balances that are given on the 1st of March 20.1. And this is where our starting point is going to be. We opened with the opening balances, and then during the year, there were these transactions that we then took place. So let's start with the vehicle. They're telling us that the vehicle, we opened with the opening balance of 28,000. But then 6 months during the year, there was a vehicle that was sold, and then the other one was bought. So then now already we can see from this that then now we have a two transaction that is then now going to form part of our movement. But then again, another thing that again that we are also picking up is the fact that they are giving us more more information regarding the cost price of the vehicle, meaning that then now this is not the information that it's not something that we are going to calculate. It's a matter of taking it and then transferring it to our solution because it's given. Okay, and then now they are also giving us let's see. Okay, so they've given us two cost price. One is the cost price for the vehicle that we are selling, and then another one is for the cost price that for the vehicle that we are then adding. But now we can already see from this information that we need to perform some calculations regarding the depreciation. Reason being, we know that from for the purpose of our assets, there is a movement that we need to deal with year. Whether we are selling or not, we know that our asset need to be to depreciate at some point, meaning that now whatever that we opened with is not what we are going to close with. During the year, it's supposed to be a depreciation that we need to then account. So now, from what we have now, we can see that the information regarding the depreciation is that then will then require us to do some calculations for that. So now I want to take you through the depreciation calculation, because from this solution we can see that the information regarding the cost is given. We don't have to perform any calculations. There is no other calculation that we need to perform other than depreciation, which is because those are all the only movements that we are picking up from this scenario. Okay, so now I'm going to share this sheet from my side just to take you through the depreciation calculation. Okay. Okay, let me do this way. Share. Okay, so yeah, you'll just confirm from your side if you can see this.
We can't see it yet.
You can't see.
We can't see it. Yeah, nothing yet.
You can't see from your side.
No, not yet.
Oh, I don't know why, because from my side I'm sharing it. Let me try again.
Tulani, can you mute us? Because maybe it's disturbing your screen. Can you just mute us all?
Can I do what?
Yeah, I've muted all.
You still can't see?
Yeah, we still can't see.
You can't see anything, or it's only the sheet that you can see because I'm projecting?
No, we can't see anything. No sheet. We can't see the thing. The Excel as well.
Okay.
We are still here. Maybe it's disturbing his screen.
Let me just.
Okay, I'm not sure why.
Is it fine, Tulani?
Is it fine now?
No, still can't see it.
No, no. There's nothing sharing now.
Okay, I'm not sure why. Because on my side it's showing.
Hi, Vuyo.
Hi, everyone.
Yeah, are you trying to share?
Tulan was trying to share the screen. I think he's Tulan. I think maybe if you log in, log out. Otherwise, I'll have to then try share the screen, my screen, but which not be ideal because I've already put the calcs in this one. Okay.
Yeah, I think he went out.
He's gonna go out and he's gonna come back in, and then if he's unable to still, if he's unable to share.
I'm in again. I'm not sure. Okay.
There we go. We can see it now.
You can see
okay,
now.
thanks.
Yeah.
Yes.
Okay. Sorry for that, guys. It's just this connection. Sometimes it can be a problem, but it's fine. We got it right now. So yeah. So like I indicated, guys, that from the information that we have, most of the figures or most of the inputs we are already given. The only thing that we identified that is missing or we're missing more information on is the depreciation. Yes, some of them, the other part of depreciation is been given, but not all. So now for us is to then calculate that part of depreciation that is missing on Voyo is
Tulani,
explained.
they're asking
we
you to zoom in a bit.
To zoom in a bit, okay.
Yeah.
Zoom. Is it fine now?
Yeah. Then you can just scroll down a bit and then it's fine.
Okay. Right. Okay, that's fine. So now we have identified on the information that there was a vehicle that we opened with, but then after 6 months, we then sold that vehicle. And then yes, the accumulated depreciation is been given the opening accumulated depreciation, but the depreciation for the 6 months we did even. So now we need to then calculate that depreciation from the beginning of up to the date or when the vehicle was. And then we can see from our scenario that of depreciation. Now, our depreciation is calculated at carrying amount. Carrying amount meaning cost minus accumulated depreciation. So now the information for that, we're given that the cost of this vehicle that was sold was 12,000. Was 12,000.
You're breaking up a bit.
So can you put the 12,000 and then accumulation with
You're breaking up a bit there, Tulan.
Am I audible now?
Just try speak. You're break.
Can you hear me now?
I can hear you now. We can hear you.
Okay. All right. Okay, that's fine. So now the accumulated depreciation, we were given that at the date of when this vehicle was sold, its accumulated depreciation was okay. We are given the accumulated depreciation at the beginning of the year. We are not given accumulated depreciation at the date when this vehicle was sold. So already we can then minus that accumulated depreciation, the opening accumulated depreciation, for us to be able to arrive at the carrying amount that we'll then use to calculate the new additional depreciation. So now our accumulated depreciation or our carrying amount, you can see that is 5,545. So this is the carrying amount.
You're breaking up again, Tulani.
That will then use to calculate.
Tulani, maybe let me share my screen. Maybe that's what's causing that. Yeah, let me share my screen, guys. I think Tulani's line is bad.
Am I audible now? I've switched the connection. I think this one will be better.
Yes. Now you're audible.
Yeah. Okay.
Yeah.
I think this one will go fine.
Perfect.
Okay, sorry for that. So you will see that I've already jotted some amount here in terms of calculating our, I can revise that so that I can talk through it. So now we're saying that our depreciation is calculated at carrying amount. Our carrying amount at the date, the time when we calculate this depreciation is 550, it's 5,545. And then we are told that in terms of the policy, that our depreciation is calculated at 20%, right? So now I'm simply going to say 20% times 6/12. So this is the 6 month that we're emphasizing on, that we didn't use this asset for the whole year, we only use it for 6 months. Hence, we are depreciating it by 6-month period. So now, which means that now our depreciation will then become 5545 over times 20 over 100 times 6/12. So this now become our depreciation for 6-month period that we use this vehicle before we sell it. And then now, so now that this depreciation for 6 months plus our opening accumulated depreciation become our total accumulated depreciation for this vehicle until the date when it was sold. So now this is what will then what you call de-recognize when we recognize this asset, right? So now we are done with the vehicle that was sold. Now we'll have to deal with the vehicles that are still available. Remember, we said that now that the movement in our assets is it is going to be your depreciation for the year, meaning that whatever that we opened with is not what we are going to close with, meaning that during the year we'll have to then calculate our depreciation for the period. So now, if we look at the depreciation for the period for the vehicle that are on hand after selling this one, we are going to then do this in terms of the cost, because we said that our depreciation is calculated the carrying amount. So now what we are going to do, because the cost that were given at the beginning for these assets, we're given the cost for the entire vehicles. That means including the one that we sold. And on the information, they gave us additional information regarding this asset to show us that the cost for that was 12,000. So this 12,000 is already included on the balance that were given on that table. So now what we need to do, because we have calculated, we are dealing with that asset separately, we need to then also take this information regarding this asset out of the balance that we were given at the beginning. So the 28,000, we are going to take out the, I think it was 12, yeah, it's 12,000. This 12,000, we need to take it out of this balance, right? So we remain with amount of 16,000. So now we are also told that, so which means that now we need to do the same principle for your for your carrying amount for accumulated depreciation. So accumulated depreciation, we said that it was, we're given amount of for vehicles specifically, we're given 14,268. So we need to take out the accumulated depreciation for what we sold, which is 6,455. So now the remaining accumulated depreciation becomes 7,813. So now that brings us to the carrying amount of how much? Of 8,187. So this is the carrying amount of the assets remaining, right? So now we need to then depreciate this 8,000 for the entire year, because this is what was remaining and it was used for the entire year. So we are not going to do any apportionment there. We are going to depreciate it fully. So now this is how we're depreciating it. We're going to say 8,000, 8,187 times 20 over 100. So that should give us a depreciation for the entire year of 1,637, right? I just want to put this on negative so that we are able to differentiate.
Tulani, just once you're done with the existing vehicles, I think there are some questions that.
All right.
Yeah,
I see
there's a hand. So I'm just gonna unmute the first one. There we go.
Okay. Okay, I can't see this.
I think the first user is 566723821. I'm not too sure. Doesn't have a name here. Okay, let's try another one. I see Nhlanhla here. Hi, Nhlanhla.
Can you hear me?
I can hear you.
Yeah, we can hear you. Okay.
Yeah, I just want to know when you calculated the depreciation, the accumulated depreciation on the second for existing vehicles. Why did you use the 6,000? Please go up a bit.
I want to, okay. So are you referring to depreciation on the vehicle sold?
On the existing vehicles, why did we use the 6,000 for the accumulated depreciation and not the total accumulated depreciation?
Oh, okay. Now I get your question. Okay. So yeah. So I just want to take you back again. So we're saying that at the beginning of the year, we were given a total accumulated depreciation for the entire assets, for all of these assets, right? So then now, there was an asset that was sold during the year, and we're told that accumulated depreciation for this asset that was sold is 6,000, right? And then we are saying now, for the purpose of this calculation, we are saying now, this asset that was sold, its carrying amount and then all its depreciation, will calculate it separate, right? So now what we are doing here, we know that this 6,000 is included in the 14,000. Hence we are taking it out so that on this calculation, we are only dealing with the information for the existing assets. These are assets that were not sold. I'm not sure if I'm making sense.
Yeah, okay, so I got that.
Okay.
So Nhlanhla, I just shared, if you look at the chat, the part of the question where it makes reference to the vehicle and the accumulated depreciation that Tulani is referring to. So if you have a look at the chat, it's on your first point of the question.
All right, sir, I got that.
All right. I think we can continue.
There are some other questions. There are still other questions.
Oh, okay, that's fine.
I see here Miss Baker, I think, or Mr. Baker have their end up.
Good evening. No, my question was answered because I was wondering with the 7813 why did you take this? So the question was asked by Nhlanhla. So thank you for this, for the answer, please.
Oh, okay. No, that's fine. Do we still
And
have
then,
another question?
Yeah, Sinazo.
Hello, sir. Can you
Hi,
hear me?
Sinaz. Yeah, we can hear
Hello,
you.
can you hear?
Yeah, we can hear you.
We can hear you.
Evening.
from our side.
Please take me through number 2, depreciation on existing vehicles. I think I got a bit lost on the calculation on accumulated depreciation. Can you please take me through the calculation? I don't know where we got to the answer 7,813. So can you please take me through the calculation, sir? Thank you so much.
All right. So I'm also doing, so thank you, Sinazo. So yeah, I think maybe I should have also, I should have maybe included this so that you can see in terms of the what we took into account. And then the same applies to here. I think I should have done this times 20 over 100. So yeah, so Sinas, I think I will have answered this. I just included this so that you can able to follow through, because we said that we are taking out the 6,000 from the 14,000 to get to 7,813. So there was nothing special that we did here. It was simple, a matter of taking out the accumulated depreciation for the asset that was sold from the depreciation that we opened with, because like I said, we have calculated a depreciation for these vehicles separately. And then in terms of how we arrived to the depreciation, we took the carrying amount of this existing vehicle. You will see the carrying amount that we calculated there, which is 8,187. So we took that carrying amount and then we depreciated it using on the diminishing balance method, using the 20% as per the policy. That's how we arrived to 1,687. I'm sure this will then make clarify the question that we have.
Thank you so much.
Okay, then I think there's another one from Karabo here. I'm just letting them. Hey, Karabo.
All right, Karabo. Come in.
Hello, sir. Can you explain where did you get the total accumulated depreciation on vehicles sold on number 1? That
Okay.
negative 7,000.
All right. Okay. So yeah, okay, no, it's fine. I can explain that. So the total accumulated depreciation on vehicles sold. So basically what we are doing, we sold the vehicle on the 31st of August 2021. So now what we are doing, we need to calculate accumulated depreciation, or the total accumulated depreciation at this date, on the 31st of August. So now, on the information, we are given accumulated depreciation at the beginning of the year. As you can see here, even with the date, we are given this accumulated depreciation of 6,000. And then now we use this asset for 6 months, meaning that we need to then depreciate this asset for that period of 6 months before we sell it. That information was not given. And then now we had to do this depreciation that you see here, that we for 6 month period, so that we can then, and then after that we then added these depreciation that we opened with and the depreciation that we calculated for 6 months to arrive at the total accumulated depreciation at the date when we sold this vehicle. That's the amount of 7,000 that you are referring to. So it's the combination of what we opened with and what we additional depreciated. I hope
Okay.
it's clear now.
So does it mean that we are also going to minus that negative 5,554?
Okay. No. So the 500 or 554, we are not minusing it from where?
I saw that you wrote the total negative 554.
Yeah. Yes, so the 554. So don't be confused with the sign. The sign is just so that when we show it, it is different from the cost amount. So the 554 is the additional depreciation that we calculated for 6 months. So we are adding this together to arrive at 7,000.
Okay.
I'm not sure if you get the flow. So we opened with 6,000 and then we depreciated these 5,000, and then now our total depreciation becomes 7,000.
Okay. And then can you please go to number 2 on the carrying value? So
Okay.
I was also confused with the negative 8,187.
Oh, sorry. So what I was supposed to do here is this, so that this one then become
Like that carrying value negative 8,000, like
it's not supposed to be negative. It's supposed
negative.
to be.
Yes.
It's
So
supposed
I
to
was
be.
confused.
Yeah, it's supposed to be positive. Sorry for that.
So it means
Right.
that also that total of 1,637 is not supposed to be a negative also, or is it a negative because it's a depreciation?
It's a depreciation. We are putting it on negative. So
Okay.
yeah, for consistency purpose, we're putting it on negative.
Yes, thank you.
Okay.
Okay, I think we can continue now.
Okay. No, it's fine. Yeah, we can continue. So now we have dealt with the so on part 2.1, we have dealt with the vehicle that was sold. We have dealt with the existing vehicles. Now we are left with one, the vehicle that was purchased. We're told that there was a vehicle that was purchased on the same date, that is the 31st of August 2020, 20.1. So now, still the very same approach, because the methodology is the same, calculating our depreciation on diminishing balance. So in this case, we know that the diminishing balance, we're saying that is cost minus accumulated depreciation, then you calculate your depreciation on that. So in this case now, this new vehicle that was bought, we're told that the cost price was 22,000, right? But then, because this is new, we haven't used this vehicle. We are bringing it into use for the first time. Hence, now we won't have any accumulated depreciation at this stage when we bought this vehicle. So now our carrying amount becomes exactly these 2,000 here, 22,000. Actually, I can even just write it there. Becomes 22,000 because there was no any accumulated depreciation. So now we are depreciating this asset for the first time, meaning that now our cost will become the carrying amount by default. So now this is how now our depreciation will look like. You will remember that we brought it into use in August we brought into use for the first time on the, so which means that now when we calculate our period on the timeline, we'll calculate it from the 1st of September up to the 28th of February, meaning that it's going to be 6 months. Okay, times 6 over 12. Okay, this is just to show the calculations so that you don't get confused when we arrive to the answers. 20 over 100 times 6 over 12. Okay, so now our depreciation for this new vehicle become 2,200. I want to put it on negative so that it can be consistent with the other depreciation, right? So now this is our depreciation that we needed to calculate relating to vehicles, right? Meaning that now we have on part 2.1, we have dealt with all the calculations. So now we are left with equipment, right? So on equipment, we were told that the equipment that we opened with, we used it throughout the year, right? We used it throughout the year, and then as at the end of the year, then we sold one, right? So in other words, it means that the equipment that we sold at the end of the year, we used it for the whole year, meaning that now, even when we provide for depreciation, we have to depreciate it for the whole year until the date that it was sold. So we are not going. I will.
Oh, sorry, no, just to add so that, because I can see on the comments they're writing, this relates to 2.1 in the question, guys. I've put it in, it's that point where on the 22nd of February, SSS sold Mr. Moonputers for 720, the cost price of 900, and the accumulated depreciation of 164 on the 1st of March 20.1. I've pasted it in the chat. Sorry to interrupt, Tulan.
Yes, yeah. So I can see in the chat. Yes, yeah. So like I've indicated that 2.1 we have dealt with, we are done with it because it was dealing with vehicle. Now we are dealing with 2.2. So 2.2, it's dealing with equipment. So now you will see even here on the calculation, we are trying to separate those to say this is the for equipment that were sold at the end of the year, and for the equipment that we used but we never sold. So we're trying to separate those. Okay, so now we are going to do the very same. We are going to apply the very same process here. We'll start with for the equipment that was sold, because this information was given. I'm just going to take, I'm not going to minus or add anything. I'm just going to take what is on the scenario. They told us that the equipment that was sold, the cost price for that was 900, right? And then they told us that the accumulated depreciation for this amounted to 164 at the beginning of the year. So don't get confused. This 164, it was given at the beginning of the year, meaning that now we are missing the depreciation for the current year. So I'm simply going to say 164. Then the carrying amount that I'm going to use to calculate the depreciation is going to be 736, right? So now, we are going to do that applying the depreciation policy like before. So for this one, they told us that now the rate for this one is 10%. It's no longer 20%. So I'm simply going to say 736 times 10 over 100. I'm not apportioning anything because we used it for the whole year. So 736 times 10 over 100. So my depreciation now becomes 73.6. So this is the depreciation for the asset that was sold for the current year, right? So now I will quickly jump to the last part, which is dealing with the depreciation, because we still need to calculate the depreciation for those that were never sold. So to arrive to that, I'm simply going to take what we opened with for equipment, which is 2.8 minus the cost for this asset that we sold, which then going to bring us to 2.8 minus 900. It will give us to 1.9, right? And then now I will do the same for accumulated depreciation as well. I will
Tulani,
take. I will.
sorry, just that I think it's a typo there. It's 736, not 26 on the depreciation for the year. Yeah.
Oh yeah. Okay.
Yes, yeah.
No, it's fine. Okay, no, that's fine. Okay, that's fine. So now we are doing the same thing, guys, for accumulated depreciation. We simply take what we opened with, then we minus the accumulated depreciation for how much is it? It's 164, right? 164 for the asset that was sold. So it's 543 minus 164, and then this will give us the carrying amount of. I just want to do this so that the layout is the same. Okay, right. So now it will give us the carrying amount of so this is what we are going to use to depreciate these asset times 10 over 100, right? So this is 15 to 1 times 10 over 100. So our depreciation on this one becomes 152.1. So I'm going to stop there. I'm going to stop there. If there is any question, then we'll take those. Then Voyo will take over to finalize the part of the required.
Okay. I think that I think on the last part there's a few people who missed you on the equipment. I think because I can see on the chat here.
Okay. I think yeah, only because on this one I was moving fast because
yeah, I think if you run through it again with them.
Okay. Okay. So now, okay, I'll just explain this. Ne? So we are saying with regards to equipment, right? We opened with this equipment. We're given the cost price of this equipment at the beginning and the accumulated depreciation for this equipment at the beginning, right? So now we had all those equipment throughout the year, right? We use all those equipment throughout the year, but then at the end of the year, there was one equipment that was sold, right? So now what we are doing here, we are simply saying that now for the equipment that was sold, let's calculate its depreciation separately. And you will see why we're doing that when Vuyo take you through the part of the required, that you will need this information separately there. So we're saying, let's take it separately there. And you will see there is nothing special that we did with this part for the one that was sold. We simply took the cost, because the information for the cost was given. We took it and then we minus the 164, which is the accumulated depreciation, so that we can arrive to the carrying amount for us to be able to calculate the depreciation for the current year, because we are on the diminishing balance method. So there is nothing special that we did with regards to this part. It was simply a matter of taking the cost that was given on the scenario, we subtracted accumulated depreciation so that we can have the carrying amount that we're going to use to calculate our depreciation. So now, on the second part, we're saying that because here we have dealt with this equipment that was sold separately, and we know that from our scenario, the balance that were given at the beginning of 2.8 for the cost, it includes the 900 that was sold. And we're saying that let's separate it so that the depreciation for the existing vehicle, for the existing equipment, we calculate it separately, right? So that's all these minuses that you see here. We were simply taking out the information for the old machine, for the machine, that equipment that was sold, for us to get the carrying amount at the beginning, because this accumulated depreciation and the cost was given at the beginning of the year, and we then had to from hour to hour, for the purpose of this scenario, the part that is missing that we need to calculate is this depreciation. So we did this so that we can arrive to this amount of carrying amount that we needed to be able to calculate this depreciation. I'll stop there if there is any clarity seeking question.
Doesn't look like there's any question on. There's no hands up here. Check on the chats. Okay, I think there's no more. Yeah.
Okay. So if there is no other question, I'm going to give you so that you can address the last part of the question.
Okay. You can unshare. Let me just share my screen.
Okay, you are good to go.
Okay. Okay, just let me know when you guys can see it. Can you guys see my screen?
Yeah, we can see your screen.
Okay, no, then fine, perfect. So basically now what we're going to be doing, because now we are now getting to the actual preparing of the required. It said, prepare the following general ledger accounts for SAS Supermarket, which are properly balanced closed off for the year ended 28 February 20.2. Remember at the beginning of the question, when I said, after I read, I said, this is ideally the templates you guys should have to take into account all of these accounts which are required of you guys from the question. So now we're just going to be running through these general ledgers, which I call tier accounts, but I'll just stick to general ledger accounts. So here it says the balance at the 1st of March 20.1. This is where we're referring to. So it's the balances at the beginning of the year. And this is where Tulani was referring to say that these are given to you. So there's no calculation needed. So you can just slot that in to your tier accounts as you go through the questions. So you know that in our general ledgers with our assets, would be debiting our assets. So the assets would be increasing on the debit side, and on the liability side, we'd be crediting our liabilities to increase our liabilities on those sides. So as you're reading through the question, even before you calculate, you're able to just slot these into your tier accounts. So I'm just going to run through them with you as well. So let's start here. The vehicles, your vehicle at cost is 28%. So you'd be here, your general ledger, your vehicle at cost. So obviously your format's going to be on the debit, credit side. You'll have your debit side, you'll have your credit side. You'll have your date, you'll have your descriptor, and in the middle for carried down, brought down, and then your actual amount here. So it said in the question here that your vehicles at cost is 28,000. So given that it's an asset, would be then debiting that 28,000.
Excuse me, sir. Can you please zoom in a bit?
Oh, sorry. Can you guys see it now?
Yeah, it should be fair now, especially on the T account.
Okay, yeah. So there it's the 28,000 and the 28,000. So in our T accounts, let's do this so you guys can see. You then now be putting that balance on the 1st of March 28. You're gonna write there your date, then your descriptor. It's the balance, right? And then 28,000 there. You'd put in your amount there, 28,000, right? It's given. Okay. Then this is what you'd refer to as a balance which is brought down, and it's your 28,000. Similarly with your equipment, they've given you here in the question, it makes reference at the 1st of March 20.1. Remember why I said it's good to have a timeline, make reference to the beginning of the year, end of the year, so you know where you are in the question. So here we are at the beginning of the year. So here we've got equipment at cost of 2,800. So in here, we are now putting the date, the descriptor, and now putting the balance there of 2,800, which has been provided to us, and of which is your balance brought down. Now we go back to your question. It makes sense. It makes reference here to accumulated depreciation on your vehicles and your accumulated depreciation on your equipment, right? Which is then seen as a liability. We're going to be increased. Remember, your liabilities will then increase on your credit side. So hence we'll then go into our T accounts now. Once we're in the T account, you've got your accumulated depreciation here. We're on the credit side, similar with your assets. Here's your liabilities here. You would then have that saying balance. It's also brought down. Balance that's brought down of that 14,268. Then similar with accumulated depreciation on the equipment, it's been provided to you. In our T account, we'd go then to the accumulated depreciation on the equipment. We'd input our date, balance, just 543. Happy days. Now, here we now refer back to 2.1 here. And now we are now at the 31st of August on 2.1. Hopefully you guys can see it now. Yeah. So it says SS Supermarket sold a delivery vehicle to Mr. Peterson for 7,200 cash. The proceeds from this sale transaction was used to help finance the purchase of another vehicle on the same date from Cape Motors Limited for 22,000, right? So that information now has been provided to you. So what now needs to happen is in our T accounts, you need to now on the 31st of August, we're going to start off by realizing here we've got the proceeds which we received of 22,000, right? And then when you go back to the question here,
Vuyo,
And-
isn't that 22,000 rand for the vehicle? You're on the T account for the equipment.
oh, apologies. This is for the vehicle. Actually, yeah, this is the wrong one. I see that. Apologies on that. That's back to the. Then, so Mr. P, then, okay, that's fine. Sorry, just lost bearing there. So we've, then here we have that balance brought down of 28,000. We received that 22,000 in the proceeds there. Now, we need to go back to the question here. And we see here the proceeds for the sale was at 22,000. You realize that he sold the delivery vehicle for 7,200. So the portion of that was sold, and then the cost price of this vehicle sold was at 12,000, and its accumulated depreciation to 6,444. So now that we are in this account, our vehicle at cost here account, we now need to transfer this 12,000 vehicle that 12,000 on the vehicle that was sold to the realization account. So by transferring it, we're then going to be crediting it out. So we're reducing the vehicle at cost by this 12,000, and then we'll then be debiting it inside the realization account with the 12,000, because now we are now recognizing the disposal, but we're starting with the cost. So what we then do, we then go, and on the 31st of August here, you now transfer this to the realization account. Your balance is 12,000. Happy days. Now, once you go back into the question here, you can see once we're looking at this transaction related to the vehicle at cost, we've dealt with here, the beginning of the year, we've dealt with the during in the middle of the year here on the 31st of August. So we have no other transactions when you look here that are related to the vehicle at cost. So once you then go back into now the general ledger, you would now be adding up. You'd say that 28,000 plus your 22,000 gives you 50,000, right? Now, once you look here on your credit side, you can already see that your debit side is larger than your credit side. And in your ledgers, they had asked for accounts that are balanced, and you know that your debit side must always equal to your credit side. So what that means that then there is a balancing figure here, which would then say balance, and that's carried down. When is this carried down? On the 28th of Feb 20.2, right? Now, because 50,000 is greater than the 12,000. In order to get to 50,000, you need to now know that what do you need here to get you to 50,000? So it would be the difference between that 50,000 and the 12,000, which is 38,000. That would then give you 50. What I'm going to do is I'm going to highlight this in blue, just to show that this is the balancing figure. And in here, I'll show that it's your 50,000 less the 12,000. And usually you just say balancing figure, right? But as this now is carried down on the first day in the next year, which means on the 1st of March 20.1, your balance now, which is brought down, would be your 38,000. Hopefully that makes sense. So that's relating to your vehicles at cost. These are all relating to your vehicles at cost here. Let's do that. Now we've closed up the vehicles at cost because we've now have a balancing general ledger, and you see that you've balanced it off, and now you have the balance that's brought down, carried down and brought down. Now we transfer over to the equipment at cost. Right. So I'll take you back to the question. Shotulani?
I see there are 2 hands and then some question on the chat. If you can take that and you proceed.
Yeah, sure.
There is question from there is hand from Ibaka. I'm not sure if I'm reading it right. It has been up for quite some time. Baka, can you come in?
My question is based on this 7.2 and for vehicle, and also it's how much for equipment, that cash. So what do we do with them? And again, the last one is how is it the realization account, the liability, equity, or an asset? And how do I know that the realization account is an liability or is an asset or is what?
So
Okay. Yeah, you can continue, View.
okay, so that 7.2, it was that delivery vehicle that was sold, right?
Okay. It's the proceed received from selling the vehicle. Yeah, it's the proceed.
Yeah, so that's
It's the
7.
Okay.
Yeah, that's 7.2 on that vehicle that was sold. We're then going to, if you look, it will be real in our realization account. We're going to take into account that 7.2 in our realization account, because here we are now dealing with your cost price of the vehicle, the ledger related to the cost price of the vehicle.
Okay.
So I'm not sure. Does that make sense?
Yes, it makes sense. And then the last thing is that, sir, can you please fix the equipment cost? It's not 2.8, it's 2,800. It's not 28,000, it's 2.8. There's an error, typing
Oh yes,
error.
yes, on the equipment, yeah.
Yes. Okay.
Yeah, so
and then can you please explain for realization account? Is it a liability or equity or what?
Your realization account is basically your account which you recognize all transactions related to the disposal of your assets and equipment. So that's the account you'll be using to determine whether you have a profit or loss related to the sale of a particular asset.
Okay. All right, thank you.
Another end is from Vusi. Nkanka's hand was up, but now it's down. Vusi, can you come in? Vusi, if you can unmute yourself, you are still on the floor.
You hear me now? Can
Yeah,
you hear
we
me?
can hear you now.
Can hear you.
Yeah,
Yeah.
we can hear you.
No, yeah, it's just there on the vehicle account. The balance carried down, isn't it? Isn't it for, like you said, for the next year? That will be 1 March 20.2.
Two. Yes, 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 sir. Apologies.
Okay. Yeah, no, I think that's all. So the realization account, it's an income account, right?
So you'll be able. It's basically your journal where you'll be able to realize where you'll transfer. You'll realize you'll determine whether there's a profit or loss on a sale of an asset.
So where do you classify it in terms of the BAE?
So
is it under assets, or is it under equity, or is it under liability?
with that account, so you take the balance. So once I run you, let me get you here, run you through it, and then you'll be able to see that it's basically the general where you see where the profit or loss. So you'll transfer the profit and the loss into the income statement using the balancing figure there. Not sure if I'm making sense.
No, it's
Yeah.
it's fine. Since we are coming to it, I will just wait until we get to that point. When I don't understand, then I will raise my question. Thanks.
Yeah, maybe just for the sake of interest of time, Vuyo, for the question that are relating to the items that we are still going to touch on, can we just pause on them, guys, so that it will make more sense when you ask them after he has explained.
Okay.
Yeah, exactly my point. Thanks.
Okay, now here on point 2, it mentions on the 2nd of February 20.2, SS Supermarket sold a used printer to Mr. Moon for 720. The cost price of it was 900. The accumulated depreciation 164 on the 1st of March 20.1. So we've already taken into account here the cost here of 2.8. And now we need to now take into account the cost, transfer the cost of the price of this printer into our realization account. So we'll be taking it out of our equipment and costs and be transferred into the realization account. So here, that balance at the opening balance, the 2.8, you've got it here. Now, on the 28th of February, you now have your realization accounts. You now, okay. Let's do this, and let me just do this, and I'll explain now. Then 900. Okay. So if you look here at the vehicles at cost, we're at that 2,800, and now we need to take out, because we've sold this printer with a cost of 900. We need to now take it out of the equipment at cost ledger and then transfer it into the realization account. So hence, we are now crediting it with 900 to show that it is no longer with equipment at cost here, and it's now being transferred to the realization account. Hence, the 900 has been credited here. And given that when you look back into the question, there are no other transactions that are related to equipment at cost in the question. So now we can go back and have a look at the ledger. When you look at the ledger, we can tally up here. We see our total here is there. You've got the 2,800. That's your total. But when you look at it relative to your 900, you can already see that there's a difference between the 2,800 here and the 900. So to balance the debits and the credit sides, you then need obviously to get 2,800. And the balancing figure here, similar with here, would be the difference between the 2,800 and the 900. Because obviously, when you look at the debit and the credit side, your debit side is bigger and your credit side is smaller. So to get a balancing ledger, you'd have that 2,800 there. And now on the same date, you'd have the balancing figure here. Which is the sum of the 2,800 minus the 900. Which when you calculate it, it gives you a balance of 1,900. Okay, now this is what's carried down. And then on the flip, on the 1st of March 20.2, this would be a balance brought down of the 1,900. Hope that makes sense. And then here, we can do it in another color here. Green, just to show that we've done now that equipment and cost. And here is what we have as our balancing figure. Hope that makes sense. Now, we are now going to transfer to the third part of your required here, part C, which says for the accumulated depreciation on the vehicles, right? Now, we started by inputting that accumulated depreciation on the vehicles, that 14,268, which is that liability which we credited. Now, this is where we are going to now take into account the calculations which were shared by my colleague Tulani, and then now try to close off this accumulated depreciation on the vehicles. So we've already put in that input, that balance of 14,268. Now, what we should ideally be doing now is going back to our calcs, and now we're looking for our depreciation for the year, because our depreciation for the year would now increase our accumulated depreciation. So when we have a look at the depreciation for the year, it would be that it would be the total of that 500 and that 554.50 plus that at 5540.40, and then also on your existing vehicles, you would then add in your depreciation on the existing vehicles for that 1637.40, and you also add in your depreciation of 2,200 for the depreciation on the vehicles that we bought of 22,000. So here we would then say depreciation, right? Okay, and this is relating. Okay, I'll break it down so that we can account for the different points in time. So on the 31st of August 20.2, we had our depreciation here of 554 for that vehicle that was sold. So here in here, you've got that depreciation there. Then now, the reason why I was breaking it up, because now I wanted to take into account at the 28th of February, 20.2.1. You now have that depreciation of that 1637.40 plus that 22, which then gives you 3837.40. Now, where did I get these two depreciations? The 1637 plus that 2.2. If you look in here, this is where Tulani ran through the calculation where we have that depreciation on the existing vehicles. So the depreciation on the existing vehicles for the year is 1637.40. And then remember, we acquired a vehicle during the year. So the other part is that second half for the vehicle that we acquired on the 31st of August. And that's how we get that balance here of, that's how we get that balance of 3837.40. Now, once you go back into the calculation, you've got your accumulated depreciation on these vehicles here. Now, you must remember, we still have the depreciation on the vehicle. We still have the depreciation on the vehicles that were sold. So with those depreciation on the vehicles sold, that needs to be transferred out of the accumulated depreciation account and into the realization account. So hence, we are now going to debit that balance on the 31st of August. So here, go back on the 31st August 20.1. We are now transferring it to the realization account. Which is the balance of 0.50. Now that balance on that 7, how did I get now that 7009.50? It's that accumulated depreciation. Remember that we calculated on the vehicle, that was sold. So it's that depreciation there of the 554, as well as the depreciation that we had that accumulated there. That's how we get it. But let me now input these balances into there. Okay. Okay. Now, once you have that, as you refer back then to say, okay, now that we have that, do we still have any outstanding accumulated depreciation transactions that we still need to take into account? So here we've taken into account here, that has been taken into account, was sorted. Now on the vehicles, we refer back to our calcs. We've taken into account on the vehicles and on the vehicles that are sold, on the vehicles that is existing, as well on the vehicles that's new. So now we can close off our ledger. Now, once you look at the ledger, what you do is you'd add the 14, the 500, and the 38 37.4, and it will give you a balance of 18,659.90. And now when you're comparing this balance to the balance that you see on the debit side, you can already see that your credit side is larger than the debit side. And you, in these ledger accounts, you need them to balance. So on the side, you already know that there's a difference between this 7 and the 18. So you'd have then the balancing figure being a debit. (28) of Feb 20.2. The balance is the difference between your 18,659.90 less the 554.50, which now gives you a balance of 11,650.40. That is now brought down, that's now carried down. And when you add the 2, it then gives you a total. When you add this 7 plus the 11,650, it should give you the balance of 18,659.90. And this is on the 1st of Feb. Of March 20 point. It's that balance brought down. Of your 18,659.9. Okay, now we're now referring to the accumulated depreciation on the equipment. The balance here has been provided to us at the beginning of the year. So we have already credited the liability of 543 here. Now in the question, it does not make, there is no, in the question, when you look at the question, there is no additional references to accumulated depreciation besides the on 2.2 where they mention here the accumulated depreciation on the printer that was sold was 164, as well as our calculation for the year. So hence we then refer to our calculations where you can now see the depreciation on the equipment sold 164, on 73.6, and for the current year here 152.10. So once you have a look there, we need now to take into account the depreciation for the year on the 28th of Feb. You have your depreciation. Which is at 225.70. That 225.70 is now the 164 plus 73.60. That's what we had calculated in there. And then Now, once you have a look at that calculation, once you refer back.
Excuse me, sir.
Sure.
Is it not the 152 plus 73.60?
Apologies, let me just.
On the depreciation where you said 164.
Yeah, so it's the depreciation there for the year. You have to look at, it's your 164 there. The depreciation 73.6, that's your depreciation for the current year here. And then you must also look at the depreciation for the current year of 152.10.
Yeah, are we not adding those two because you wrote 164? That's right.
Yes, we should be. Apologies. So, didn't even type back. Yeah, it's at 152.10 plus 73.60. Yes. So, okay, now that's, yeah, that should type back. Apologies. I was looking at the incorrect. Now, once you have a look at that, once you refer back to your question here on the side, you look for any further transactions that are related to your accumulated depreciation on the equipment. But once you look here, you've had a look at there, they said that the cost price of the printer was 900 and the accumulated depreciation amounted to 164 on the 1st of March 20.1. So the cost, the accumulated depreciation now needs to be the accumulated depreciation that we had, the depreciation that's related to the equipment, which is the depreciation at the beginning of the year, as well as the depreciation for the year, needs to now be taken out into transferred into the realization account. So when you have a look at that, that would have taken place at the 28th of Feb, 20.2, and you have the realization. Account. Which is at 237.60. And this is the sum of 164 plus 70.60. Now that's the calculation where you've had your accumulated depreciation there of the that 164 and the 73.6. That's all related to the equipment that was sold. And hence we're taking to the realization account there. Now we can see in our question that there are no longer any transactions that are related to the cumulative depreciation on the equipment. So now we just need to tally this up. Which would give you then a balance of 768.70. And this is the sum of the 543 and the 225.7. The two of this give you that 768.7. Now you can already see that your credit and debit sides do not add up. So we already know that the balancing figure should then be on the debit side, which is now the difference between that 768.7 minus 237.6. Close that, and that gives you 531.10. And now if you add up this 237.6 and the 531.1, it will give you that total there. And then they balance. Now we need to now take this balance again. Here, balance. Okay, now this is you brought down. .7, and then here, that's you carry down balance there. Now for your accumulated depreciation, this would now be your balancing figure here. And then here, we've now closed that journal ledger. Apologies, ledger. Now we've gotten to the realization account here. This is the account where we recognize the transactions or the entries related to the disposal of both our vehicles and also our realization on the equipment. We're also recognizing transactions related to the equipment. Sorry, I see a hand or question.
Thanks for interrupting. I saw that you wrote the balance brought down of 768.70 again.
Apologies. Sorry, I'm just cognizant of time. I know that it's already
And also
past.
on vehicle, please. Also on vehicle.
Yeah, just bring that down. Okay, cognizant. Yeah, we go. There we go. Apologies, guys. So that is your brought down balance. Yeah. And then that's also your carried down, that's your brought down balance, guys. So that's your 11650.4 on your accumulated depreciation. And on your equipment here, it's at 531.1. And that's what's carried down, and this is what's brought down. Apologies for that, guys. Is there any other questions?
Yes, I need to know from the vehicle one, why did you use the balance for 18? It's 18,659 minus 554.
Sorry, on my vehicles.
Yes.
You're saying 18?
This 18 is 18,659.9
Yes.
0.90 minus 554.50.
Yes.
Why did you use the balance, the whole balance from the credit side minus this one to get the balance carried down?
Okay.
Instead of taking this 18,659 minus 709.5.
Yes. So here you've got here that on the balance side, so you've got depreciation. So on this side, we've added up here, which gives us this 18,659.9, right?
Yes.
We agree on that, right? And then on this side
Yes.
here, now we've got the 7. Sorry, guys. I apologize. I apologize, guys. Here. So on this side, so just let me remove confusion. Remember, we got the depreciation at the beginning of the year here, and then we got the depreciation for the year here, right?
Yes.
And that gave me the total of that 18,659, right?
Correct.
And then on this side, remember we were now transferring that accumulated depreciation on the vehicle that's sold, right? So we're debiting it out and we put it, it's gonna appear in our realization account. So in the realization account, which I'm gonna do now, you're gonna start to see this, you're gonna see the 7009.5 being credited in the account.
Okay.
Yes, so
Okay.
you'll be, and then I'll make reference to it. And this is the balancing figure here, because remember on your debit, your credit and your debit side should always be equal, right?
Yes.
Hence, I'm highlighting these because these are your balancing figures.
Yes.
Yes.
All right.
Did I remove confusion?
Yes, I'm covered. Thank you.
Are there any other questions, Tulani?
Yeah, you can take
Okay.
another one from the user here is 5667231. Okay. Okay, it's not coming in, but there is another one from one science. Okay, because my mic is what?
Okay.
They're not coming in.
Okay. Is there anything else? And other questions?
Can you hear me?
Yes, we can hear you.
Okay, thank you. I would like to know on the accumulated depreciation, the one with 160 and the 157, you added 73.6 on both sides, debit side and credit side. I'd like to know, how do we do that? Is it possible? And then how is it possible?
Okay, so that's 73.6 here, that debit, and on the credit side, right?
Yes.
So that's 73.6, and this 73.6, it relates to that equipment that's sold, right? So the carrying amount, if you look in this calculation here, that equipment that's sold, you see the accumulated depreciation here is 164, right?
Yes.
At the beginning of the year, and then we had that depreciation of 73.60, right?
Okay.
Now this 164 is that accumulated depreciation at the beginning of the year, and then the 73.6 is the depreciation during the year, right?
Okay.
Now the reason why we're debiting it out, we're debiting it out, and it's going to be we're taking it into the realization account.
Okay.
And this is where we're going to in the realization account, because remember there's an asset that has been sold, so the equipment has been sold, and we are now going to recognize it in there to determine what the profit on the loss on the sale was. So you'll see here what's going to happen is this balance is going to come into your realization account, and we shall now credit it into it.
Oh, okay.
Yes.
And then what do we call the account which can be credited and debited at the same account?
It's a ledger. It's just that we are now transferring it out. So ideally, if we're transferring it out, because remember, it's no longer part of the accumulated depreciation that sits here. It's been taken out. We cannot recognize it because it has been taken out, remember.
Okay.
Because it's been sold, so it's not sitting in this ledger anymore. That accumulated depreciation is being accounted in the realization account because now it has been sold. It's gone. So we're taking out that balance by debiting it out.
Okay.
Similarly here, you're going to see the same thing here. It's also there in the realization account. We're going to be taking balances out as well.
Oh, okay. Okay, thank you. I got it.
Okay. Okay. Is there any other question? Okay, let me then just proceed here. Now in the realization accounts, let's start now with on the vehicles, because anyway, we're discussing the accumulated depreciation. Remember now we've taken out, okay, let's start at the top beginning here. We've taken out the vehicles at cost here. That remember the cost of 12,000 out of this account in the realization, we've transferred it out. So there was that vehicle that was sold. It was sold at a cost price of 12,000. So that 12,000, we're taking it out of the equipment vehicle at cost, and now we are now taking it into the realization account. And in this realization account, it will be on the 31st of August. You'll have the balance that says the vehicle. Yeah, at cost. And the balance there is that 12,000 that has been taken out of that. Now, similarly with the vehicle at cost that has been taken out, we also need to recognize that accumulated depreciation that has been taken out. And that is that part of the 7009 on the calc for that depreciation, accumulated depreciation that has been taken out. That's why I said that 7009 will come back again. It's that accumulated depreciation of 6455 plus the depreciation on the year for the vehicle that is sold, and that's how that 7009.50. Now we've taken it out of the accumulated depreciation here and we're transferring it into the realization account. So here similarly on the 31st of August, you'll have your accumulated depreciation. On your vehicle. And it's that balance of 7009.50, right? And we also received related to the disposal of the vehicle, because you've got your cost, you're taking out the cost, you take out the carrying amount, you've also received a proceeds for that vehicle. And in that question, they mentioned that the proceeds on this vehicle here, if I refer you back to the question here, they say the proceeds on the vehicle that we received is a balance of 7,200, right? So here on the vehicle here, we're saying bank. Here, 7,200 here. Let's do that. Okay. Now, when you look at this, even if you look at this in the calculations, if you think of it in this way, your cost is 12,000, right? And then your accumulated depreciation here is a balance of that 7009.50. If you calculate the difference between the two, so if you say the 12,000 less the 7009.50, it gives you a balance of, I'll just do it on the side quickly, balance of here. So it's balance. So if you take the 12,000 less your 7009, 0.5. It gives you a balance that's equal to 4990.5. Now, if you think of this, this is actually your carrying amount at the 31st of August. So that's your carrying amount at the 31st of August. It's that 4990.50, right? Now you received 7.2. So now the difference between the 7.2 and this 4990.5 is actually your what you profit on what you have sold the vehicle for, because the vehicle has a value of 4990.50. You're selling it for 7.2. The difference gives you then your profit on your sale, if you think about it here. Another way you could also look at it is you then look at another way of also looking at this. There's two ways of looking at that. Was the one way. Another way of also looking at this, you can look your credit side is 7009.50 plus the 72, which then gives you a total of that 14,209.50. And then here you get the 14. If then that 14,209.5, when you compare it to the 12,000, you can already see that there's a difference between that 14,209.5 and the 12, which then would then equate to a profit on your sale of your vehicle of 2209.50. So what I'm going to do in this, I'm going to, like the other ones, I'm highlighting it there so you guys know that this was the balancing figure there. And once you calculate that 12 plus that 229.50, it gives you that 14,209.50. And then your account then balances there. I'm hoping that makes sense there. And this profit on sale would be realized in your, so this profit on sale, you'll recognize it in your income statement as a profit on sale of 2209.50. Now I'm going into the realization account. Similarly with the vehicles, you had on the 31st of August, 20.1, you're going to have your equipment at cost and the here. Now, because we had that equipment at cost, we'll start off here with the equipment and okay. We have the equipment at cost here. So let me take you back to the question quickly, sorry. Now, here it says on the 31st of February 20.2, SA Supermarket sold a used printer to Moon for 720. That's the cash, so we got that, that's bank. The cost price of the printer was 900. The accumulated depreciation was 164. So now they've already told us that the cost price of that printer is 900. So now in the realization account, in your equipment and cost, we had mentioned here that we are transferring that 900, we're crediting it out of this equipment. We're crediting it out, taking it out, and then transferring it into the realization account, that 900. Now, they also told us that we also mentioned that we have an accumulated depreciation balance there of that 237.5. 37.6, which we are transferring to the realization. So we would be debiting it out of the accumulated depreciation and crediting it into the realization. And that balance .60, we're taking it out of that balance there into the accumulated depreciation account. Now, similarly, with that example, you can apply both. You could think of both. Okay, no, we just wait. Just read then the one thing I forgot here. We sold this printer for 720. So we got 720. So in this account, we still need to take into account our cash proceeds of 720. So we still need to take into account the bank of 720. And similarly to the bank, so crediting. $720. Now, similarly here, as we're done with there, if you think of this also in the similar way, we've got your equipment at cost and you've got your accumulated depreciation here of that 237.6. And that accumulated depreciation is the calculation of it's at 164 and your 73.6. Which then gives you that accumulated depreciation here that we've credited. We've taken it out of here, your accumulated depreciation on your equipment, here, that balance, and we have now credited into your realization account of equipment. We've taken into account the bank of 720. Now you can also think of it, if you take your 900 minus the 237.6, that gives you your carrying amount. So if equals that 900 minus your 237.6. That gives you what your carrying amount is. Uh, 0.6 gives you 662.440. Now, $62.40. Now, when you think of that, that's your carrying amount. And when you look at that 662.40, that is what the value of this equipment is. And when you compare it to the proceeds that you got of 720, you can already see that you've realized a profit on this because you've got a value of 662 and you've got you receive 720 on it. So the difference then, it will result in your profit on sale of your equipment. And that is, when you look at it, similarly, you can add, it's a difference of, let's just add here quickly. The total of that 237 it's 957.60, and that is a different that is now your 237.60 and your 720. It gives you that 956.60. You can, when you look at it, for it to balance, the difference in there is the 57. When you look at the 900 and this 9, let's put the total here, the 957.60, and you compare this balance with that balance. it then would give you then your profit of that 57.60 there. So here, when you look at it, that profit, you're looking at here, let's do like that. The 957.6 minus the 900. And that then gives you your profit there that you of 57.6. Okay. And that's now you're balancing there. Now the last account which we're left with is the depreciation. Now the depreciation balances were calculated during the course of the year for us. So we already have these balances. So when you look at them, we'd have on the 31st of August. Uh, 20.1. You'd have then your depreciation of that 554 on your vehicles. So we're starting with the depreciation there on the vehicles there. Of 5450. We also calculated that depreciation on the vehicles here. If you remember on this page here, it's that depreciation that we had here, the 554.50 on the calc so that you guys can see it. And then we also, let me just say here for your vehicles, let's go via vehicles. And then also you need to take into account the depreciation your depreciation here on the equipment. Now we had already calculated that accumulated depreciation on equipment. If you look in this side here, okay, accumulated depreciation on the, oh, I see I missed one. Apologies, guys. I see I missed also the depreciation because this is the depreciation on the vehicles that we bought during that 554 is the depreciation on the vehicles that was sold, the depreciation on the vehicles that we calculated here, just on that vehicle that was sold there, the 554.40, that was on the first part of the year for it. So from the 1st of March to the end of the 31st of August, that was the depreciation on it. And then we also need to take into account the depreciation for the existing vehicle, for the existing vehicles. Which, when you look at this, it's a balance of, here we have the depreciation on that existing vehicle, which is the 16. It's at 1637.40 plus the 2.2, which gives you then the total of 3837.40. So then you must take that into account, that 3837.40 0.40. And then you now need to take into account the depreciation. Now that we're done with the vehicles, we've taken into account, this is the depreciation on the vehicle, the first half of the year for the vehicle that was sold. Now we're taking the remaining on the existing one. And now we just need to take into account depreciation on the equipment, which when we look into our calcs here, depreciation on the equipment is at 73.60 plus at 152.10.
I will.
Hey, Tulan,
Yeah, can you just correct ne, on the on the depreciation, they just correct the contra accounts there.
is
Is
accumulated depreciation. Yeah,
yeah, just correct.
yeah. Okay. Then you go accumulated. Okay, and then that's accumulated. And then now we've taken into account the our depreciation for all the equipment and vehicles. Now what we need to do is now tally up and transfer the total into the profit and loss account. So the total on this, on the 554.5, the 3837.4, 225.7 is a total of 4617.60. And now, given that there's been no contra entries into the credit, your credit side, you'd now look to say, okay, where is this? Because we need our debits and credits to balance. This now must now be transferred to the profit or loss account. And it will be transferred with the it will be transferred with the balance of that 4617.60. And those would be your entries for your ledger. Yeah, apologies on one or two of the stuff here, but are there any questions? Tulan, are there any questions?
Yeah, so there are a number of hands that I see. I'm just going to recognize them one by one. I will start with Nokukanya. Nokukanya can take the floor. Then will be followed by Lerato. Then I will take the questions on the chat. Nokukanya, I see. Okay, Nokukanya disappeared. Lerato, you can take the floor.
Okay. What is the difference between, am I audible?
Yes,
Can
you
you
are
guys-
Audible, Lerato.
Okay. Yeah, what is the difference between the profit and loss account and the profit on sale account?
Now, in your profit and loss account, you take into account in your profit and loss account, you take into account both your, should I say, let me start it like this. In your profit account, you take into account now the profit on the sale, right? So in that account, it's a profit on sale. So you would only recognize a profit or loss on a sale. So if there's no sale of equipment or assets, you wouldn't recognize any entries in that account. Now with your profit and loss account, in your profit and loss account, you recognize all your income and expenses that are related to the profit or loss account, and then determine what is your profit or loss. Does that make sense? Does that make sense? Or did you not hear me?
No, I did hear you too much.
Oh, sorry.
It's just so, yeah, I did hear you. But yeah, I understand as we go through though. Thanks.
Okay. Nokukanya, I see you are back. Nokutula, sorry, it's Nokutula. You can come in. Nokutula? Okay, I'm not sure if it's on their side. Okay. While we are still waiting for Nokutula, we can take Sipesik. You can come in, Sipesik. Are you able to unmute someone from your side? Because it seems like it's the...
Allow Mike, let me try this one. I don't know if Noktula.
If you can.
I'm trying to unmute her. Allow my
Yeah, it's open.
Okay, thank you. It's open now. I've been unmuted.
Okay, who's this?
This is Sipesihle speaking.
Yeah, okay, it's fine. You can take the floor, Sipesihle.
So we only on the realization account, we only recognize transactions where we have sold equipment or vehicles on the realization T accounts.
Yes.
Okay, because we are trying to find out whether it is a profit or it is a loss, and then we take it to profit or loss account.
Yes, that's the aim. That's why I was trying to show the vehicles and the accumulated depreciation, so that you understand also the rationale behind the debits and the credits.
Yes, no, it makes sense. Thank you very much.
Okay.
All right. Can you please try to unmute Nokutula before we go to Karau? Because I see it seems like
I think okay.
Hi everyone.
Hi Noktula.
Thank you. My question is on a revision exercise 10 point or 11.10.2.
Okay.
Okay, it's on B actually, where it says the estimated lifespan of the machine is 8 years, and then the trade-in value is 9,000. So I'm a bit confused here because they didn't give us the percentage on calculating depreciation. Should we use the 20% per annum on the straight line method?
Can you just tell me which example is it again?
It's 11.10.2.
On page.
I think
11.10.2. Okay.
Revision X.
Size. Yeah. What I'll do, I'll have a look. We can do it. Let's just deal these ones, and then I'll sit back and answer this one. I just need to try
Do it
open
later.
it, and
Okay.
yeah, I just need to find it and open it for you.
No problem. Thank you.
Okay.
all right. I think we can recognize Karabo now. Karabo, yeah.
So can you please go back to the realization account of the equipment? I mean the depreciation, sir, sorry. Can you please explain me those two accumulated depreciations, sir, for vehicle and equipment?
Vehicle and equipment. Yeah? Okay. So these depreciations here, these are the depreciations which we calculated here. Nah? So now when you look at here, we have that this depreciation 554.50. So I'm referring you back to the calc here that we did on it that was done. Is that this is the first depreciation on the vehicle that was sold on the. So it's that depreciation, but it's that depreciation from the 1st of March till the 31st of August. So the first half of the year. Does that make sense?
Yes, sir.
And now the other part of it is now the depreciation. When you look at it, if you look at that, you have that existing vehicle, right?
Yes, sir.
So we depreciated, remember the existing vehicle for the depreciation was at 1637.40. And then we also bought we bought that new vehicle for 22,000 and we depreciated it for the second half. So if you look at these two, if you add these two numbers, it will, if you add that 1637.40 and the 2.2, it gives you that balance there of 3837.40. So if you look at that, it's that depreciation on the existing vehicles and the depreciation on the new vehicles. Does that also make sense?
Yes, it makes sense.
And now with the equipment, when we look at that, it's based on all of these are just based on the calcs that we calculated here when we look at all of these. It's that depreciation on the equipment that was sold, that's 73.60 and the 152.10. So if you add those two up, it gives you that total of 225.70, and that's your depreciation. And now we're debiting the expense.
Okay, sir. And so can you please go back to the realization account? I don't understand because I'm seeing three amounts on the debit side, which is the equipment at cost and the profit and loss and the 57.60.
Yeah. So if you look at this, on the realization account, you look at here, this vehicle, this was the vehicle that was, that's the vehicle that was sold for 12,000. Remember the cost, right? So in here, we're taking out initially what we're doing with the first one. There was a vehicle that had a cost we had debited in here. The balance was sitting in here. So we took it out and we credited it out and transferred it to the realization account. So hence you're seeing here we had credited out of the vehicle at cost, and now you are now debiting it here in the vehicle at cost, the contra account at 12,000. Because we're now taking it out of the vehicle cost and we're transferring it into the realization account. And then with the accumulated depreciation on the vehicle here, we had that balance there of that 2,000 of the depreciation, and we had depreciation for the year. Now, because we sold our vehicle here, there was a calculation which we did on the vehicles that were sold. If you look here, so you see that depreciation on the vehicles that were sold. It is the sum of that accumulated depreciation here of that 6455, which is that accumulated depreciation at the beginning of the year, and then also the accumulated depreciation for that first half of the year. Now, what is happening? We're selling this vehicle, so we need to we're taking that accumulated depreciation out of that accumulated depreciation on the vehicle Hence, we're debiting it and transferring it into the realization account. And in the realization account, where here you see we're crediting that 7009.50. And then when you, okay, they were transferring it. And then in the question, they mentioned that we got 7.2. So now this is the proceeds we got here. In here, they said they sold the vehicle to Mr. Peterson for 7.2 cash. So once you look in that account, that 7.2 is bank, the cash that we received. And now this is your balancing figure here, which is that 2209.50. But I also made that example that also look at it in this way. You could also consider this way. When you get your cost less your accumulated depreciation, that gives you your carrying value. Then when you compare it with your proceeds, which is bank, it gives you this figure here. But how you should look at it, we've followed the process of the vehicle at cost has been taken out of the vehicle at cost here, 12, and it's been brought down here, and we're debiting it in here. The accumulated depreciation on the vehicles, we have now, it's been taken out of your accumulated depreciations, hence we're debiting it out, and then we're now, here you're seeing it there, we're crediting it with that 7009.50. Then we're now transferring those proceeds from bank into here. It's that 7.2. And then once you tally up, you see we've got 14209.5. And then because you know our debits and credits our credits and debits must match. If I exclude this, you'd already see, because we've already got this entry, we've got this entry, we've got this entry. Now, this is the total. Now, the difference between this 14209.5 and the 12 is what gives you that 2209.50. I can actually put it there. Minus that. Does that make sense?
Yes, it makes sense. Thank you.
All right. So the next hand, I see CP is back again.
Oh, no, sorry, say it was from the last question, sorry.
Okay. So I don't see the other end for you. Let me check in the chat as well. I don't see anything fresh. Okay, I don't see anything on the chat as well, and then there is no hand. So I guess there are no more questions.
Okay, if there are no more questions, thanks, guys. Apologies, we ran over. Yeah.
But I see Vusi raised hand. Can you come in, Vusi?
Yeah. Earlier, I asked whether can we get access of the spreadsheet document that you are using for the presentation.
Yeah, I can. Yeah, I can share the document. I can share it, and then it will be distributed.
Please, thanks.
All right, no stress.
Okay. Yeah, I don't see any more questions. I think we can then close it.
Okay, no, I'll still be on the line because there are some people that I just asked them till the end. So I'll still be on the line to answer those questions that were specific to a specific example, etc. But otherwise, everybody else, thank you for your time. It's quite late now. Apologies for running over.
Are you still here?
Yes, okay. Lerato. Sorry,
Yeah,
yeah, can you just run through the
I
question
was
again?
actually, yeah, I was actually raising that question for that the volume method that was used in one of the
Yes,
examples in the, yeah.
yes. Can you just remind me your question? Sorry, I ran
In the
through.
one example in the exercises, they've given
Yes,
us the number of units per year,
yes.
and they were calculated for 5 years. In total, it was 2,000 units. So what I was asking is this, should we expect a question on this volume method? Will we be giving this units per year as it is in the book, or is there a determining factor? Is it always like 500 units 1 year or like that, or does it came given like today's question, what was like 20% on the vehicle and 10% on the equipment?
Yeah. Yeah, with that one, what I would you because it's on the production, it's the production unit method. You can't now be applying a percentage, right? Because that depreciation method, it depreciates your assets based on the units produced, ne?
Yeah,
As
but
as that percentage of the unit expected. So you would have to look at what units are produced, right? So you have a total figure which is your expected, right? And let's say it's based on units, so it's no more percentages. We're applying units to this. So let's say we're gonna produce. I buy a machine, and it's expected to produce 100 units over 5 years, right?
Okay.
And now every year we maybe produce 20, right? 20, 20, 20. That then means that we are now having to go 20 units that we produce over the 100 that are expected. That's what we'd be applying. So I can't apply that. You can't apply a percentage. Sometimes the 100, let's say the 100 could be split in different ways. It could be 10, 30, 10, and 50, right?
So but
then you
should we expect this question, this units will be given to us?
ideally, that's my understanding. You should be given units, but I could confirm. Let me confirm with the lecturers that you can I get your name and surname so that when I confirm, Noktula, I will. Hey Noktula, I'm gonna respond now. I just want Lerato's name and surname so that I can confirm. And
yeah, it's Lerato.
Yeah.
Sekgotodi with SEKGO.
SEKG. Can you spell the full one so that I don't misspell it?
Yeah, Sekgotodi.
Okay.
Todi, TODI.
TODI.
Yeah.
Okay, that's
Yeah.
fine. I'll just ask them, and then if we're able to send you then an email just to confirm. Or can you also share your email once I confirm, that I can maybe just say that that's it, if you
Okay,
don't
cool.
mind, in this forum,
All right.
unless you're uncomfortable with it.
No, it's okay.
And I check something, Ratone. Are you saying on the exercise that you were doing, those
Yeah,
units were not provided?
No, they were
they
provided.
were.
They were provided.
They were provided.
Yeah.
Yes, because
Yes.
I will surprise if you saying the units were not provided, because
No, they were
I don't.
provided over 5 years. But what surprised
Yeah,
me is one, like first year will be like higher than the second year, the third
Yes.
year will be lower than the fourth year. So but what my question is, it's not like it's 100% 20 20 20 or 100% 10 20
yeah,
30, the other one. Yeah.
No,
So that
yes,
was
yes,
just
yes,
my
yes.
one confusion.
Oh, okay. Now I understand the question. No, they would need
yes,
to provide you with your units. They would have
yes,
to provide
yes.
you with the units, because
Okay.
remember, you need to know how many units you're producing in order to depreciate it, right?
Mm,
So you
Yeah.
have to be provided with the units. You cannot not
okay.
be, yeah, okay. No, that makes sense. No,
Okay.
you cannot.
Okay. Thank you so
Yeah.
much.
All right.
All right.
Hi, Noktula. Sorry. Let me.
Hello.
Oh, hi, Noktula.
Oh, okay. My question was on the revision exercise 11.10.2. I don't know if you can open it, or should I read it out to you?
I've got it open, but just not on this thing. I've got it open on my tablet. So
Oh, okay.
yeah.
No
I can.
problem. There on additional information on
Yeah.
B, where it says the estimated life time for a machine is 8 years. But now I see the calculation for the machine is 20%, but how come it's 8 years? Because it's supposed to be 5 years.
I just want to open now the solution so that I see what you're referring to on the solution.
Okay.
So it's saying here the estimated lifespan of cheetah machine is 8 years, and the estimated trade value is 9,000. Okay. Depreciation on the zebra and garage machines is provided for 20% on the straight line. Okay, that's on the straight line, right?
Yes, not on diminishing.
Yeah. So your question is, why are they?
Why are they saying the lifetime is 8 years? Isn't it supposed to be 5 years when it's 20%?
But when you look at it, the estimated life there is, let me see here, the I'm looking at trying to look at the solution here, where they are making reference to. Because they're saying on the first one, they're doing the 20%, right? On the zebra one, eh?
Yes.
And then on the second one, they are doing the 16,000 plus 4,000, then the 20% again.
Okay.
Okay.
Yeah, Voyo, I think she's raising the number of years.
Yes, she's raising it, but I need to read through the question because there may be something that I may be answering, and there's something that they have mentioned there. Okay, it's fine. Just in the interest
Because
of time,
I was thinking if it's 8 years, maybe they might have used the diminishing balance method, because on that one, it will be 8 years. But if it's a straight line, it can't be 8 years, the lifetime for the machine.
yes, it's they say the depreciation on the zebra and jaguar machines is provided 20% ban. But let me read this. On the first
Okay,
of
what about
January,
that one?
on the first of board additional credit. Oh, I see Mohokon has his hand up.
Mr. Buyo, how are you?
I'm fine, thanks. Sir.
On that question of is 11.10.2,
Yes.
the 8 years is the additional information. It's just part of the scenario.
Okay, so the
Yeah, the 8 years is part of the additional information. It's part of the scenario. So
okay.
we can't change it to 5 years. It's just the information from the question. It's 8 years. This is the estimated life of a cheetah machine.
Oh no, that's a cheetah
Zebra and
machine.
Jaguar
Yes,
is
Zebra and Jaguar is
20%.
20%. Yes, I can
20%.
see.
Yes, that one is cheetah machine.
Yeah,
It's
that's
8 years.
cheetah. Yes.
Yes, it's 8 years. So there
Okay,
is no
sir, but
error.
does that mean that we have to calculate the cheetah machine on 20% as well?
No, on the
No,
8
cheetah
years.
machine, you calculate it using 8 years.
Yes.
Because the additional information saying the estimated lifespan is 8 years. And the other two, Zebra and Jaguar machines, then you can use 20%. Because this is part of
for the third
additional
one as well.
information.
Yeah, they're
Yes,
different
this is part of-
machines.
Okay.
Yeah, they're different machines. Yeah, Zebra and Jaguar is the 20% and the cheetah is 8 years.
Hello. Yes.
answered?
I'm not. No, I'm not answered. I just want to confirm if the cheetah machine I should use 20% as well, like the other two machines.
No, you must use 8 years because the information is saying use 8 years.
Oh, okay.
This is the part of this is
So
part of the additional information. It's part of the it's part of the scenario. 8 years is just the other two machines
so
you must use
it means
20%.
it's 12.5%.
Which one? It's 8 years.
It's
It's
8
not
years.
20%.
Not percent. Here we are
You're
talking
gonna
about
use 8 years. Yeah.
Okay. 8 years. Okay. Can I please make sure on this one? Because if it says it's 100,000 the cost price and 5,000 installation cost, that means the total cost price is 105,000. So my depreciation is going to be 105,000 times 12.5%. Am I right?
With that, you must also, okay, now I've read this question. On that, they've told you the estimated lifespan of the cheetah is 8 years, and the estimated trade-in value at the end of the term is 9,000. So remember how when you're depreciating an asset, what it is. So you've got that 100,000 plus the 5 installation. You must include the 5,000 installation, which gives you the 105, right?
Yes.
And then you must deduct the 9,000 because that's the value, the end of the estimated trade-in value of 9,000. So you deduct that to give you a depreciable amount.
Okay.
Then you divide
of 96,000.
Yes, then you divide that by 8 because it has an estimated lifespan of 8 years.
Oh, okay. So my depreciation now is going to be 12,000.
Yes, if you take that, the calculation, let me just quickly calculate it. If you take to that, so you go the 100,000 plus
5.
The 5 gives you 105, right?
Yes.
Now you need to then deduct you estimate the value at the end of
9,000.
that 9,000, right?
Yes.
And then you
That's
divide it by your 8, apply your 8.
Okay.
It makes sense, yeah. Just remember, because they're using two the zebra and the jaguar are on the straight line method, right? So they'll apply 20%.
Yes.
Now the cheetah
Okay.
machine is being depreciated based on its estimated lifespan of 8 years.
Okay.
Because yeah, I think let me not confuse anything. Yeah.
And you must also use the timeline because there's
Oh, I see, because it was bought on the 1st of July.
And your year end is the 31st of December. So you've got that 6 months, right?
Yes, yes.
So that's where your
Oh,
timeline comes
okay.
and your 6 months, it comes into place.
Okay. I'll apply that as well. Thank you so much.
Okay. Thank you, Mr. Mohon.
oh, thank you.
I'm not too sure. Are there any other questions?
No, there's no other question. Maybe we can continue.
Okay. Thank you, guys. Sorry, this.
Oh, thank you very
It
much,
was
man.
yeah. Apologies.
Yeah,
I
thank
was
you for
trying
your
to
input.
explain. Yeah.
Yeah.
Thank you. Bye.
Cheers, everyone.
Bye.
Okay.